Hey, Dan Passarelli here. Happy Friday. We made it through another week. What a good week it was to close out the market. Closing at a new all-time high. SPY closed at 663.70 today. That puts the market up, not just at a new all-time high, but up 13% for a year that we're not even 3/4 through. There was a lot of volume today. Now, there's a lot of volume today because, well, it was triple witching. Triple witching means that we've got different types. We've got the equity options expiring today, index options, and treasuries all expiring today. With all those quarterly, monthly options expiring, we tend to get a lot more volume in not just the options market, but the stock market as well. But does that mean we had a big range today? No, it doesn't mean that at all. And it turns out that that was pretty expected. If we look at our 0-day hero here, we see that right within not even a minute and a half of the market open, we had over 1,000 iron condors trading in SPX today, and only trading for a quarter. So somebody was very, very confident that it would not be a volatile session today, and that humongous trader was correct. Other things, I told you that we would talk about this triple witching in terms of the treasuries. Well, yeah, let's talk about that. The yield curve, which is simply a graph that represents where the yields of treasuries of different maturities are, it's a pretty important thing to look at, and it can give us a lot of answers unless it's weird. And it's weird right now. Normally, what we like to see in the yield curve is we like to see the short-term rates wherever they are, and then the longer-term rates at a higher rate. That indicates confidence that the economy will do better and that interest rates will have to go up in correspondence. When we get an inverted yield curve where the current rates are whatever they are and future rates are lower, well, that indicates that, things aren't going so well and rates might need to come down. Well, here's what we got right now. It's really neither. It's this humpy sort of yield curve. Kind of weird, right? We got these short-term rates here in the 4 to 4.2%, but when we go out like a year, 2 years, 3 years, we've got interest rates lower, which indicates that people think the economy is doing poorly and interest rates need to come down. And then after that, we've got interest rates shooting up a great deal higher, a full over 100 basis points from the projected low here. What to make out of that? Well, I don't know. There is a lot of buzz about interest rates coming down at the Fed, which should pull down other interest rates as well. Is the economy doing poorly to warrant that? I don't know. Let's talk about next week. Well, next week, we don't have a lot on the menu, but the things we do have on the menu are a pretty big deal. We've got GDP and PCE coming out. PCE is the Fed's preferred inflation gauge. That's probably, it's been the most important number of the month. Nowadays, probably the monthly unemployment number is going to be a little bit more important than that one. So it's probably the second most important number. We also then have earnings. That's going to be starting in just about 4 weeks or so. Oh my goodness. So we get not really a rest up because we've got all these other things to consider. Also, the Senate did not pass that stopgap bill, so we still got 11 days from now the looming government shutdown, which could be trouble, but we all have faith in the U.S. government. I'm sure they'll work together. Have yourself a great weekend. Rest up, study hard, and come back next week to trade smart.